class, and welcome to demo problem number 3 for chapter 12, Learning Plan 2. Basically, this will be the last video for this learning plan, and I will demonstrate problem 12-2 and problem 12-5. Now, I did have it here, but I created this amortization table ahead of time so that you guys can have a better understanding of what numbers I'm using for the interest revenue when we record it for requirement 3 in problem 12-2, so that you can kind of see and understand a little bit better. The way I looked at it was this is the best way that I can help you understand that, instead of just showing you what was needed to be done. So basically, once we get there, I'll show you guys what I mean once I get to the requirement 3. But basically, like I was going to say before, your homework assignment is problems 12-2 and problem 12-3. And problem 12-2 is going to be consisting of trading securities, which is what we're doing. Problem 12-3, which is in your homework, your graded homework, and I believe it's also in your practice homework. It's on securities available for sale. And the accounting will be very similar to that of the trading securities. So it is accurate that if you are saying that problem 12-2 is going to be done the same as 12-3. So to save a little time, I won't go over 12-3 because it will primarily be the same, exactly the same. So if you understand 12-2 and you have this amortization table, and of course, along with this demonstration video and the practice homework, I'm sure that you will understand it. So basically, that's what I wanted to stress before we move on. But okay, so let's start out. This would be problem 12-12. Excuse me, 12-2, and it's on page 715. And I'll read the problem, and then we will go ahead and do the problem together. Okay, and as you might notice, problem 12-2 has the same scenario as problem 12-1, which is what we already did in the first demonstration video. But the 12-1 was on securities held to maturity. So the accounting for that is a little different. But because this is for trading securities, the market value or market yield rate does in fact influence the interest that's going to be recorded. So that is the difference here. And like I said before, with the securities available for sale, the market yield is also important. So that's why that's what I told you, that this trading securities and securities available for sale, the accounting is primarily the same for both, which is why I'm not demonstrating 12-3. All right, so just this. And just a reminder that if you are doing the homework practice problems for 12-2 and 12-3, the problems, you can skip requirement 5. If you want to do it in the practice homework, you may go ahead. But I did take it out for the assigned homework for problem 12-2 and 12-3. Okay, so continuing on. Fuzzy Monkey Technologies, Inc. purchased a short-term investment, $80 million of 8% bonds dated January 1st on January 1st, 2013. Management intends to calculate the interest in a short-term active trading portfolio. For bonds of similar risk and maturity, the market yield was 10%. The price paid for the bonds is $66 million. Interest is received semi-annually on June 30th and December 31st. Due to changing market conditions, the fair value of the bonds at December 31st, 2013 was $70 million. Okay, so for requirement 1, we are to prepare the journal entry to record Fuzzy Monkey's investment on January 1st, 2013. Okay, so our journal entry would be a debit to investment in bonds at the face amount of $80 million, and I'm going to basically, and I believe Connect requires that you do it this way, and it'll be in millions. I'll just denote that up here. Numbers are in millions. Okay, so all these numbers will be in millions. I'm going to show you it this way because the other problem 12-1, I showed you the full, instead of saying in millions and just doing 0.8 or 8 million. I did it where I wrote out the whole number. So I'm going to do it where I'm going to do 8.1 or 6.4 and so on, so that you can kind of tell what Connect is expecting of you when you do the homework. Okay, and you'll know what's expected once you do the practice problems. And same goes for your graded homework. It's going to be exactly the same as that. So hopefully this will help. Okay, and then our discount, we have to record that because the bonds were sold at a discount. Which is our difference. And I won't put that in yet. And then the cash that we paid price of bonds. Okay, so the price for the bonds were 66 million. So our discount then was $14 million. Okay, so that is requirement 1. Requirement 2. All right, in requirement 2, we're going to prepare the journal entry to Fuzzy Monkeys by Fuzzy Monkey to record interest on June 30th, 2013 at the effective rate. Okay, so this is the time where interest is going to be paid to the bondholder. And so we're going to credit a debit cash, which is going to be 4% of the 80 million. Remember, they yield 8%, but because we are calculating interest semi-annually, we're going to take half of that 8%, which is now 4%. And then we're going to debit the discount on bond investment. And then we're going to credit interest revenue. Now, interest revenue is going to be 5%. Excuse me, 5% of the 66 million. Okay, so let me just do that here. Make sure that you have decimals in here because it's going to have a decimal when you're dealing with such large numbers. And then my interest revenue is going to be the 5% of the 66 million. Okay. All right, so my difference then is going to be the discount of, once again, of 0.10, or remember these numbers are in millions, so that would be 3.2 million. This will be 100,000. That would be 3.3 million. Okay, so that's how that one looks. All right, in requirement 3, it's asking us to, and let me just do something here. Okay. All right, so in requirement 3, It's asking us to prepare the journal entry by Fuzzy Monkey to record interest on December 31st, 2013 at the effective rate. Okay, so here's where the amortization table comes in. And I'll show you which numbers to use or how to do it. So basically you can do it two ways. And let me just get my accounts in here first. I'm going to just copy this here. Cash. Because I know it's going to be the same. But this one's going to be a little different. My interest. It's going to be 5% of the 66 plus the 100,000. Okay. Or you can take this balance here. All right, so that's the balance that we are calculating interest on, the 72,045. And hopefully that is what we're doing. Okay, hold on here. So I didn't double check this earlier, but let's do this here. 4% times 80. Okay, let me just get my decimals in here. All right, let me just cross-check my numbers. Okay, so let's double check our numbers. I had to go back and fix a few things here. Apparently I was using the incorrect, when I created the table, I was using the incorrect interest. So I went back and fixed everything. So basically, let's double check our numbers. So if we take 5% times that number, which should be the 66 plus 0.1 here, which is the 66 million plus that discount here, okay? It should equal the 3.31, okay? So 3.31, that 5 is just rounded to a 1 here. So basically that's how that looks like, right? So hopefully you understand that. So that 66 plus 0.1 or that discount on the bond investment, you can do it that way. It's easier if you do have an amortization table, but if you don't, you can always go 66 plus 0.1 and then 66 plus 0.1 plus 0.11 if you were to do the discount, the interest on June 30th, 2014, and this is supposed to be 13 here. There we go. Okay, and so this is interest at December 31st, 2013. All right, so that's that one. Okay, requirement 4. I'm going to scroll down a little bit. Okay. In requirement 4, it asks, at what amount will Fuzzy Monkey report its investment in the December 31st, 2013 balance sheet, and why? Prepare any entry necessary to achieve this reporting objective. Okay. So first of all, I want to just say that Fuzzy Monkey reports its investment in the December 31st, 2013 balance sheet at its fair value of the $70 million for this case. And for investments in trading securities, the changes in the market value or the market returns, it provides an indication of management's success in deciding when to acquire the investment, when to sell it, whether to invest in fixed rate or variable rate securities, and whether to invest in long-term or short-term securities. So with that being said, we first then need to determine the investment's amortized cost or the book value at the end of the year for requirement 4. Okay. So investment in bonds, we will have then, this is how it's going to look on the balance sheet. You can have your investment in bonds, okay, let me just go in here, investment in bonds of the 80 million. Okay. Less a discounted bond investment. It's basically the discount total of 14 million minus the 100,000 minus the 110,000 here. Okay. That should take us to, and let's put decimals in there again. There we go. Should take us to 13.79. Okay, and I just put a negative in there so that it kind of shows the investor that, hey, it's a subtraction. Then our amortized cost then is 66.21 at that time. All right, so then to record it at fair value, we would increase the investment by the 70 million, okay, minus that 66.21 that we just calculated, and therefore we would get to 3.79 million. So our fair value adjustment then entry would be 3.79, and we would credit the net unrealizable or unrealized holding gains and losses, which is the 70 million again minus the 66.21, 3.79. Okay, so that is our entry for this particular requirement. This is the amount that Fuzzy Monkey will report in the investments at December 31st, 2013. And that is our journal entry. And once again, because these are trading securities, the unrealized holding gain of the 3.79 would be recognized in Fuzzy Monkey's 2013 income statement. So that's that one for 12-2. Hopefully you got a better understanding of trading securities. Like I said, the securities available for sale accounting will be the same as this. So if you follow along with this for 12-3, you should also do perfectly fine. If you do have questions, go ahead and email me. But for now, let's get to 12-5. Okay, so here's problem 12-5, and it's on page 716. I'll go through and read the problem, and then we'll go through to it together. All right, so the following selected transactions relate to investment activities of Ornamental Insulation Corporation. The company buys securities, not intending to profit from short-term differences in price, and not necessarily to hold debt securities to maturity, but to have them available for sale when circumstances warrant. Ornamental's fiscal year ends on December 31st. No investments were held by Ornamental on December 31st, 2012. So they gave us a bunch of 2013 and 2014 transactions. Then let me do requirement 1 first. Requirement 1 is to prepare the appropriate journal entry for each transaction or event during 2013. Okay. Boy, can't type here. Requirement 1. Okay. Okay. So February 21st. They acquired Distribution Transformers Corporation common shares costing $400,000. So we can debit investment in Distribution Transformers shares in the amount of $400,000. Okay. And we can credit cash because looks like we paid cash. You can assume we paid cash since they didn't state anything else. Okay. Then on March 18th, they received cash dividends of $8,000 on the investment in Distribution Transformer common shares. So we're going to debit cash for the $8,000 and credit investment revenue for $8,000. Okay. On September 1st, they acquired $900,000 of American Instruments 10% bonds at face value. So once again, investment in American Instrument bonds, and we paid cash for $900,000. October 20th, they sold the Distribution Transformer shares for $425,000. So we sold some investments, so we're going to get cash in. So we're going to debit cash. We're going to take the investments of the American bonds out. Excuse me, the distribution bonds shares. And we're going to credit. It looks like there's a gain because we bought it for $400,000 and we sold it for $425,000. So we got $425,000 off of it. Bought for $400,000. So our gain then is going to be $25,000. Okay. On November 1st, we purchased M&D Corporation common shares costing $1.4 million. So investment in M&D Corporation shares of $1.4 million and credit cash for that same amount. All right. So here are the transactions. I'm going to highlight them so that you guys can see them a little better. Kind of just look like a cluster to me. There. All right. Hopefully that looks a little better. And then at December 31st, record any necessary adjusting entries relating to the investments. The market price of the investments are American Instruments bonds is $850,000 and M&D Corporation shares $1.46 million. Okay, so for this, I'm going to kind of scroll down a bit. Okay. Oh boy. There we go. Okay. So I'm going to go ahead and do make a table first. Basically, Well, before we do the table, I'm going to record interest first because that investment for the American instrumental bonds here, even though we bought it in September and interest has not yet been paid, but it's the end of the year, we have to accrue interest for that. Even though it hasn't been paid, we technically did earn the interest revenue, so we have to accrue interest for that amount. And let's denote it as American instrument bonds, okay? And the investment revenue. Okay, so that revenue is going to be based off of the 900,000 times 10% times 4/12 because only 4 months had passed, so that is the interest that we would have to record. And that gives us 30,000. Okay. So it's saying that this entry, it's saying that we've earned 30,000 in interest revenue for the American instrument bonds. Even though they haven't paid us, we have to accrue interest for that amount so that our balance sheet, excuse me, our income statement is correct and our net income is correctly stated. Okay, now another thing that we have to do is we have to adjust either gains or losses based on the M&D Corporation shares and the American instrument bonds because they are not held to maturity and they are available for sale or trading securities. We must go ahead and adjust them to the market value at the end of each reporting period. So to show you step by step on how we do this, okay, I'm going to go ahead and make a table first. Okay, so my available for sale securities is the M&D Corporation shares and the American instrument bonds. Okay. My next column is going to be the cost, and then my fair value. Let's just spell it out. And then my accumulated unrealized gain or loss. Okay, so here's our table. Okay, so we got our cost, we got our fair value. Just make this a little bigger. There we go. Okay, everything still looks good. Let's just save it. Okay, so the cost of the M&D Corporation shares was 1.4 million. Okay, and the cost of the American instrument bonds is 900,000. My fair value, it states in the book at that time for the M&D is 1,460,000, and for American Institute bonds it's 850,000 at that point in time. Okay, so my gain or my loss here is going to be my fair value minus my cost. So I have a gain for the M&D Corporation shares of 60,000. And I have, looks like a loss of the American Instruments bonds of 50,000. So if I net my two together, okay, my adjustment for the fair value adjustment is going to be $10,000. Okay. So my entry then, I'm going to debit fair value adjustment for 10,000, and then I'm going to credit my net unrealized holding gains and losses, other comprehensive income of 10,000. Okay. All right. So that's what we do for requirement 1 for December 31st, 2013. So remember that $10,000 here, the credit balance in that net unrealized holding gains and losses, is reported as 2013 OCI, which is other comprehensive income, in the statement of comprehensive income, and it serves to increase accumulated other comprehensive income, a component of shareholders' equity in the 2013 balance sheet. Okay, so that's that one. Okay, I'm going to continue down. I'm going to just keep scrolling down. Hopefully that when you print it, I think what I'm going to do is I'm going to go ahead and do this to it so that when you print it, it's all on one page. Well, we're going to be able to, let's see here. Let me go down. I'm going to try to see. I'll fix all this though, so that when you print it, that it comes out nicely, hopefully. Okay. Okay. So that's that. In requirement 2, indicate any amounts that ornamental installation will report in 2013 balance sheet and income statement as a result of these investments. Okay. All right, so requirement 2. The first thing that they have to do is on the income statement. Okay. They had investment revenue. The 8,000 and the 30,000. Okay. So they're going to have to report that. Okay, so remember from March 18th here, that 8,000 and then the 30,000 for the interest here. Okay, that's what they're going to be reporting on the income statement under investment revenue. Okay. And also that gain on the sale of investments. Even though, let's see here, where is it? Yeah, right there. Okay, which is 25,000. So that's what they're going to be doing on the income statement. And just to note that unlike for trading securities, unrealized holding gains and losses are not included in the income for securities available for sale. And then for the statement of comprehensive income, the net unrealized holding gains and losses on investment is at 10,000 that we just calculated here. Okay, so that's going to be the income statement here for that 38 and 25, and then the statement of comprehensive income, they're going to report $10,000. All right, on the balance sheet, this is how it's going to look like. There are assets, current assets. We've got the investment revenue receivable, of the 30,000. Okay. Then we've got our securities available for sale. Okay. That okay, hold on here. Which is, oh, and I forgot to total these up. That's probably why. Let's do this here. Oh, nope. Undo. Right here and right here. There you go. There's our 2.3. Okay. All right. So that's our securities available for sale of 2.3 million. That's going to be reported in the balance sheet. That's how it's going to look like. Plus the fair value adjustment of the 10,000. Okay. So we'll have this reported as such. All right. And then for the shareholders equity section, okay. This is how the net unrealized holding gains and losses will look like. Which is the 60,000 minus the 50,000 of 10,000 from above. Okay, so that's the balance sheet area. So let me just kind of highlight that so you can kind of see. I'm going to get a lighter color in there, and then the income statement and the I'm just going to kind of do this so you kind of see the difference there for requirement 2. Okay. All right, so just remember that the statement of comprehensive income, okay, it can be reported either as a combined statement of comprehensive income that includes net income and other comprehensive income, or as a separate statement of comprehensive income, this area right here. All right, so that's that for requirement 2. Keep scrolling down. Okay. For requirement 3, prepare the appropriate journal entry for each transaction or event in 2014. Okay, so in 2014, we've got 5 different transactions. January 20th, now let me make sure that, okay, on January 20th, they sold M&D Corporation shares for $1.485 million. So if we sold our investment, we're going to be debiting cash for the amount. We're going to debit a gain on the sale because definitely we have a gain. Let's make this a little bit. Did I say debit? I meant credit. Okay, every time we have a gain, it's a credit. A loss is a debit. And then we're going to take the investment off the books. At the cost amount, because it's reported at cost of $1.4 million. Okay, so that's how that looks like. All right, on March 1st, they received semi-annual interest of the $45,000 on the investment in American Instrument bonds. Okay, so we received our investment. We're going to record that $45,000 as cash. We're going to debit, credit investment revenue receivable for that $30,000 that we recorded above. Because remember earlier, we had to accrue interest here. Okay. even though we did not receive interest in or interest payments in, because it's year end and we have to make adjusting entries, we had to accrue for the $30,000 that we technically earned but have not yet received in cash. So because we already put it in a receivable account, at the time of when we actually receive the payment, we're going to reduce that receivable, okay, and then credit cash for that $30,000 plus the investment revenue for the and this investment revenue here is only from January through to March, okay, or actually for only 2 months, January and February, because it was paid on March 1st. So for that 30,000. Oops, excuse me. Nope. It would be this minus that for the 15,000. Okay. Let me just highlight this so we all have a good idea of where all our entries are. Okay. So this right now, if you look at this investment revenue receivable account, okay, it should be at a 0. At first, we debited saying that we've got that coming in, okay, well, showing here investment revenue, a receivable account. It's going to come in at one time or another, and when it came in, we credit it. So credit and a debit equals 0. So we technically received the cash in of $45,000, which is that $30,000 accrued at the end of the year, plus the couple months that we didn't actually accrue for yet because it's not year end. So, but because we get the payment of interest before year end, we would record those 2 months, reduce that receivable for that $45,000. Okay. Okay. On August 12th, and let's just make sure. Okay. August 12th, we hold on here. Acquired vast communication common shares costing $650,000. Okay, so we're going to debit an investment account. In the amount of $650,000. Okay, let me just copy and paste all these over here. And delete these so that I want to make sure that they're all in order so that it doesn't confuse you later on. Okay. And then we're going to credit cash for that same amount. Okay. Hopefully that didn't change anything. Nope. I don't think it did. Okay, we're still good. All right. Okay. And then on September 1st, boy, September 1st, they received semi-annual payments on interest and $45,000 on the investment in American instrument bonds. Okay. All right. So once again, we're going to debit cash for $45,000 and then investment revenue for $45,000. I don't know why this is doing this. Okay, there you go. Okay, so that's September 1st, and now it comes to December 31st where we have to make our adjusting entries. We're going to record any necessary adjusting entries relating to the investment, and the market prices of the investments are Vast Communication Shares is 670,000, and American Instrument Bonds is 830,000. All right. Get out of there. Come on. There we go. Okay. All right. Once again, we've got to make that adjusting entry for the, let's see here. Which investment was it? Yep, the American Instrument Bonds. Okay. So our entry will be then the same thing as up here. So I'm just going to go ahead and copy that. Where'd it go? Here we go. Okay. For 30,000. All right. Remember earlier, because interest is paid on the 1st and interest is also paid on March 1st and September 1st. Because once again, it's year end, okay, we must make this adjusting entry to accrue for interest that we have earned but not yet received. Okay, every year, December 31st, you can say that every year until these bonds mature, we're going to make this adjusting entry. Same way, 4 months every single time. All right. And then once again, we have to do the same thing here, right here. Okay, so what I'm going to do is I'm going to just copy this down. Okay, but the names are going to change for the securities. We've got the Vast Communications Shares, and we've got American Instrument Bonds. Okay, all right, so this one is at 600,000. Fair value states in the book that Vast Communications is 670,000, and it's 830 for American Instrument Bonds. Okay. All right, so far this is what we have. And this must be 2014 here. Okay. So far, we've got Vast Communications and we got American Instrument Bonds. They both cost, well, Vast cost 650,000, American Instrument Bonds cost 900,000. The fair value as of December 31st, 2014 is 670,000 for Vast Communications and 830,000 for American Instrument Bonds. The gain we have at 20,000 is for Vast Communications, and there's a loss on the American Instrument Bonds of 70,000. That means we're at 50,000 negative right now. Okay. So let me just write here. Write this. Moving. So we're going to be moving from a positive 10,000, which is from the previous year that we had earlier that we did the problem for the two investments, 2013, to a negative 50,000. Okay, so so basically this requires a decrease of 60,000 in our fair value adjustment. Okay. All right, so let me just lay this down here. Our balance needed in the fair value adjustment will be 50,000. Okay. Our existing account balance and the fair value adjustment right now holds 10,000. Oops. Okay. The increase or decrease needed in the fair value adjustment will be 60,000. Basically the 50,000 plus the 10,000. And I should have just done this like this. Okay. All right. So we determined that this year we've got a loss of 50,000 on our investments. But from last year in that fair value adjustment account, we've got a $10,000 positive in there. So to move that 10,000 all the way to a negative 50, we have to adjust it for $60,000. So my entry would be a debit to net unrealized holding and gains and losses, and this will be on the other comprehensive income section for 60,000. And then my fair value adjustment, which is calculated above, for the 60,000. Okay. All right. And just a little note on this again. The 60,000 debit credit, excuse me, the 60,000 debit balance in the net unrealized holding gains and losses is reported as 2014 other comprehensive income in the statement of comprehensive income, and it serves to decrease accumulated other comprehensive income, a component of shareholders' equity in the 2014 balance sheet from the $10,000 credit balance is showed on that 2013 balance sheet to the 50,000 debit balance it shows in the 2014 balance sheet. So that's that for that requirement 3. Okay. So hopefully you can print this out and follow it along for your graded homework. All right, requirement 4, and this will be the last requirement for this problem. Indicate any amounts that ornamental installation would report in 2014 balance sheet and income statement as a result of these investments. Okay, so same thing as we did before that had asked us in requirement 2 here. Okay. All right, so in requirement 4, in the income statement, we will have investment revenue, okay, which is the 15,000 plus the 45,000 plus the 30,000. All right. That 30,000 is this right here of the accrued interest that have not yet been received, but we have to record. The 45,000 for the cash investment, okay. That was when interest was paid, and then the 15,000 for the partial interest that we accrued through March 1st for the other investment. I believe that is the American Instrument bonds. So that is our investment revenue. Okay, and then gain on the sale of the investments for that 85,000. Okay, and that is, where is it now? Right there. Okay, we sold the M&D Corporation shares and we had a gain of 85,000. All right. And then under the statement, of comprehensive income. Okay. We've got a net unrealized holding gains and losses on investment. And it was that 60,000 that we calculated here. Okay. That's that one. All right. In the balance sheet, that's all for the income statement. In the balance sheet, let me just highlight this. Okay. In the balance sheet, we've got then under current assets, there are investment revenue receivable for that 30,000. Okay. Right there, right here. Okay. Then we've got our securities available for sale. Now I'm going to put this over here. Of the 1.55 million. Okay, and that was, where is it now? Right there. Okay, that's both of our securities there. And we're going to then subtract the fair value adjustment of that 50,000. Oops, not 50. Okay. So that's going to equal then 1.5 million after subtracting the fair value adjustment. And then for the shareholders' equity, we got the accumulated other comprehensive income, which is the net unrealized holding gains and losses, which is basically that 20,000 minus the 70. Of the 50,000, which was calculated here. Okay. All right. And I believe that's it. Let me just make sure I highlight this so that you can see it once you print it out. So that's what we have for problem 12-5 requirement 4. Your homework problem, assigned homework problem, will be very similar to this. You will have practice problem very similar to this as well. So make sure you fully understand it before you go ahead and attempt the graded homework. I will attach this to this video so that you have the notes, okay? I'm going to go in and make sure that when you print this, oh, don't do that to me. Okay. Well, anyway, I'm going to figure it out before I post it, but this is it. These are the video. This is the video. This will be the last video for this learning plan. And once you are done with this, you can go ahead and there's a test for this learning plan along with the previous learning plan. So the test will involve Chapter 6 and Chapter 12. If you got any questions, make sure to give me an email, shoot me an email, or call me.